Take us in, Salar.
Welcome to episode 5 of Fin Talk with Paris and myself, Salar. Going and starting everything off. Paris, we had a small little break, but now we're back at it. You mind leading us off with some market news?
Yeah, long Easter break, but now we're back at it. Happy to see you in I guess not in the flesh, but in through Zoom again. But I'm
Likewise.
happy to be back on the podcast. But starting off as we always do with market news. As of today, the market's about to close in 5 minutes, but the S&P is up currently 0.01%, very flat day. Dow's up 0.06%, and the Nasdaq down a little bit under a third of a percent. So it's been a pretty flat day today. Moving on to vaccination, just as that's speeding up lately, 30% of the country is now fully vaxxed, and 44% of the country at least have one dose. And the CDC just announced, I don't know if you heard this, Solar, that we can go outside
Mm-hmm.
without masks,
That's
and unless
awesome.
it's a large gathering. So that's the caveat there. Moving on, Biden announced that a new potential bill on capital gains tax could increase revenue by 113 billion and kind of change the structure of capital gains, more like how income tax works, into a progressive basis system. So that's potentially in the works.
Mm-hmm.
Speaking since we're talking about Biden, the S&P has been up about 24% since his election for the new year. So from November through March. Also, another tidbit fact: from November through March, investors have poured more money into equity-based funds than they did the last 12 years, and that's according to Bank of America. So we're having a lot of money pouring into the stock market, and we
Mm-hmm.
have not seen a lot of pullbacks as of late.
Mm-hmm.
One last little nitpick fact is oil consumption is nearing pre-pandemic levels, and in China, it's already surpassed pre-pandemic levels. So if we're really trying to see this moving back into regular life and what it was like pre-pandemic, we're really starting to get the info and the facts here that kind of back that up, and that things are starting to get back to normal, inshallah. But
Yeah,
yeah, would you like to introduce our target? That's our market news, but would you like to introduce our topic for the day, Solar?
sure. Yeah, thank you very much for leading us in. Those are very interesting topics to look into. I am happy we're going back to pre-pandemic life. I am not happy about the fact that gas prices are almost $5 here in California.
Oh yeah.
So we have to do what we do with that. But leading into the conversation today, mid-March, you had a total meltdown by a hedge fund by the name of Archegos Capital. So today we're going to be dissecting all the routes. We're going to be talking about who is Archegos, who is Bill Huang, why did Archegos melt down, all the caveats that have to do with that, the timeline of the meltdown, and what we can look for afterwards. But Paris, if you want to go ahead and lead us into and sort of define and give us a little bit of backstory on what is and who is Archegos Capital.
For sure, for sure. So as you said, Archegos is owned or was owned now by Bill Huang, who was a former protege of the legendary investing titan and hedge fund manager Julian Robertson. I know
Mm-hmm.
you were a fan of him, Solar.
I do.
So
I'm a
basically, this
fan.
means he's Bill Huang is a so-called Tiger Club, as he used to formerly work for Robertson's massive fund, Tiger Management.
Mm-hmm.
Huang then founded Tiger Asia in 2001. So he moved from working for Julian Robinson and founded Tiger Asia in 2001. And at its peak, this went on to grow to over $5 billion fund. In 2012, this firm pleaded guilty to insider trading and settled a civil suit with the SEC for about $44 million. And a year
Ouch.
later, the firm rebrands and changes their name to Archegos Capital.
Mm-hmm.
What the firm would focus on was public stocks in the US, China, Japan, South Korea, and European regions. And it had large positions in Viacom, Discovery, and a lot of New York listed Chinese companies like Tencent, TechDo, GSX, and such. Um, that was kind of the basic background of what Bill Huang's origins were from and how he evolved to found Archegos. But that's not really why they're in the news as we're talking about them now. Because last month they had a big event happen in
Yeah.
their firm's history. Would you like to little elaborate more on that, Solar, and what kind of happened with Archegos last month?
Perfect. Yeah. Thank you very much for the introduction. And yes, it's a very big meltdown, actually. So I'm going to go ahead and give you a slight overview, and then I'm going to go ahead and start from the beginning of when everything started. So essentially,
Great.
Archegos Capital, Bill Huang's firm, defaulted on their margin calls, causing all their prime brokers to essentially defunct and sell their, well, not really defunct, but suffer massive
All their money.
losses. The Archegos hit, not just from Archegos, which lost $30 billion, all of its fund. It's now a defunct fund, but the repercussions of that actually have a lot of Wall Street firms and a lot of their prime brokers losing up to $10.5 billion, from Credit Suisse to
Ouch.
Goldman Sachs to Morgan Stanley. So these are a lot of people who are, and they're not just normal like small players. These are large names, very household names, and sort of the centerpieces of Wall Street, if you will, who got hit by this meltdown. But let me go back a little bit in time. And by back a little bit, I mean, honestly, last month. So in March 26, 21, last March, we actually see that, Viacom and Discovery, who are two large media giants, were actually downgraded by Wells Fargo. So what that means is, the analysts will come out and they'll give analyst ratings and they'll say it's good rating or bad rating, so on and so forth. And they were actually downgraded by Wells Fargo. Now, of course, when something does downgrade, that's not a very good thing for you to be downgraded by. It's not a very good thing to happen when your firm is downgraded, and investors also lose quality and confidence in that firm. So once they realize a firm or a company they're invested in is downgraded, they have to go ahead and start following the cycle, which actually caused a pretty big sell-off. So two things happened here. Viacom closed 27% lower. From a high of $100.34, they were at $48.23. Discovery slumped another 27%. So they closed, their highest was $77.27. They closed at $41.90. So a lot of media stocks started falling too. Fox Corporation, AMC News, they were down 6%. And these are large players within the S&P 500 too. So they're wondering, like, what happened here? So they're trying to go through this whole situation through cycle, and they actually found out that two things happened. There were large block trades within these funds, companies, I should say. And what happened is that they were actually levered 25 times higher than analyst estimates in 2021. Viacom was trading for almost 25 times what the analysts were estimating it at, and Discovery was trading almost 27 times what analysts were saying it should be traded at. So that goes to show that something's going on here. Now, in the beginning of March, there was also a large sell-off. Viacom actually reported that there was $2 billion in shares being sold after the record high. So the next day, it fell almost 10%, 9.1%, dragging down Discovery as well. So on that Friday, what happened is they said that there were large block trades for both of these shares. And they actually found out that it was Goldman Sachs and Morgan Stanley adding to this large selling pressure. So then they're echoing volatility. They're saying, what's going on here? What's going on? Why is everything acting so volatile? How come, is it the downgrade? Is it the block trades? Why is everything being sold? So they found out that, there's a plethora of things going on, but the block trades actually were initiated by Goldman and Morgan Stanley due to the fact that, as we mentioned, Bill Huang's Archegos Capital defaulted on their margin calls. So let me go a little bit and explain what exactly is a margin call and how exactly does that work. So first, let me discuss a little bit about the block trade. So Goldman Sachs actually traded $10.5 billion in a block trade. Now, what's a block trade? A block trade is essentially when you have two parties. Let's say you have the prime broker and you have the person selling. So in this case, you have Archegos and Goldman make a deal after market. So after the market closes, behind closed doors, they make a private deal that, hey, look, you need to kind of sell these stocks so we can mitigate some risk. We can start delevering, essentially. So not only do you have these multimedia giants being lit up and being sold, you also found out that some Chinese stocks were being sold here. So it's a little bit interesting. Now, the Chinese stocks are being sold due to the fact that under SEC law, once you are a foreign nation or any other stock that is listed on the stock exchange or any exchange, you must be open for the SEC to come in and investigate your books. It's a complete open book policy. And once you're warned, it's kind of like a 3-strike, you're out. I don't know the amount of strikes, but after a certain amount of strikes, the SEC comes in and they delist your company off these exchanges. So when you have Baidu, when you have Tencent, when you have GSX, I believe, and Viashop Holdings that were recently just opened to the U.S. and now they're saying, nah, you can't read our books, and China is declining the because we're America, and for whatever reason China doesn't like America and America doesn't like China. They don't want to open their books to us because maybe it's a fishy company, maybe their cash flow isn't right, maybe a lot of stuff is going on that they don't want us to see, but they want the extra capital raise. That's not a good sign. So going back to the block trades, a lot of people are questioning, like, what's going on? Why are all these large block trades? Because not only do you have America, our chat rooms, our Bloomberg terminals are lighting up, you have Hong Kong's Bloomberg terminals and chat rooms being lit up. So they're sort of sitting here saying this is unprecedented. We haven't had this larger block trades going on in a while. This then leads into Archegos Capital. So what happened is that they kept liquidating their portfolios. They kept selling. Archegos tried to sell a lot of their stock so they can mitigate the risk, and delever essentially. So I said a lot of words. Let's go ahead and compact them and unpack them. So what is a margin call? So when you have a margin account, and essentially, let's go back a little bit. What's a prime broker? So let's say, Paris, you were, I don't know, Wallace Capital Management, let's say.
I like the sound of that.
That's a great sound, exactly. And I'm Goldman Sachs, and I have a prime broker desk. What happens is you and I get into an agreement. You say, hey, buddy, look, because I'm a hedge fund and I don't have direct tapping to the market, I need to go through a third party. We broker a deal, and there's also other services that a prime broker can go ahead and discuss about. But the main one is the fact that I can then lend shares to you. So how it essentially works is you say, look, hey, buddy, I need X amount of shares from Viacom. I say, no worries. You call my desk. I'll hook you up. You're tapped into my Bloomberg. I give you that shares. It's technically not your shares. They're my shares. I'm letting you borrow. When whatever deal we make, you keep some of the profit and you kick me back some of the profit.
And the compensation would be a fee to you. So Wallace Capital would give you, Goldman Sachs, a fee for lending me the shares. Okay.
Exactly. Yes. So it's good because, you have a lot of players working together. It's, it can be bundles. I could be securities lending. I can even do cash management for you. I can do a lot of stuff. And it's not just hedge funds. I can do family offices. It's endless when it comes to prime brokers. But there's a minimum account size, and a margin account is essentially what we're talking about. So you want to purchase cash. You want to purchase securities. Stock. How do you purchase that? Well, you need cash. How do you get that cash? We'll set up a margin account for you. I'll say, all right, Paris, here's our margin account. We talk about this rates. We talk about, the amount of capital you need. Perfect. We're all cool. We're all set. So here's the thing. You need to have what's called a maintenance margin, which is the baseline floor. If anything falls under that baseline account, let's say
and that's my money I'm putting up front.
And that's your money you're putting up front, but I'm kind of backing you on that kind of.
Okay.
So, what happens is if you fall under that, the brokerage firm, I will call you and say, buddy, we need to do a margin call. What you need to do in order to get your maintenance margin, you either need to offload some of your positions so you can pay for that, or you need to put more cash in. So how does this pertain to Archegos Capital? You had Goldman, you had Credit Suisse, you had UBS, you had a lot of big players in the prime broker field telling him, look, Bill, you got to keep up on your margin. You got to maintain your margin. You either have to sell some stock to offset, or you have to put some more money in there. He said, no worries, I got you, buddy. So all this stuff is going on. But then, in order for him to do so, he comes in and says, all right, why don't we do this? Why don't we do a total return swap? So it's a type of derivative. And what is a derivative? It's a contract between two parties that essentially, it's a contract that derives from the underlying asset. The value is derived from the underlying asset. So when you have a swap, you're talking about maintenance fee. You're talking about the stock itself. So there's swaps on your Viacom. There's swaps on all your positions that you have. But with Bill over here, what he thought was a good idea is that, hey, let's go ahead and put some swaps on his positions. So how does a total stock swap work? Let's say, and there's two parties here. It could be more parties, but usually it's two parties. So we have a 1 year let's say you and I get into a 1-year agreement. One party, let's say you, Paris, you'll get the you'll get an offered rate, so like the S&P 500 or whatever underlying asset we discuss about, plus a 2% fixed margin. I'm paying you. You get to keep the asset, and you get a 2% fixed margin over a certain period of time that I have to pay to you.
Mm-hmm.
On the receiving end of that, because it's a total return swap, I, the other party, receive a total return on a principal amount. So let's say, for this example, I get the total return of S&P 500 index with a total principal amount of $1 million. So let's say the stock goes up that I gave you is 3.5%, and the S&P increases by 15%. We can go ahead and work out there's a deal and some math involved that we pay each other.
Yeah.
Yeah,
Some
so
sort of
pretty much
formula.
that assumes, the receiver, myself, I assume the systematic or market credit risk. The payer, you forfeit the risk associated with the performance of the security, but you also take on the credit exposure that I take. So if someone is paying, they will take on the risk of the receiver. All the receiver has to do is you take on the market risk. Sounds fair. So as a payer, there's no risk associated. I just pay you, you do your thing. But the only issue is I have exposure to that credit. So if you default, I'm screwed. It's not really you. You're paying me, but if anything happens to whatever assets happening here that defaults on the credit, it doesn't end well for me because I'm I'm receiving. So I'm paying it. So that's essentially what happened with Archegos. It was a giant mess. You have key players all over, right?
Yeah.
And I've said before, when you're dealing with people like Goldman and UBS and Credit Suisse and Morgan Stanley and Nomura Holdings and Mitsubishi, and the list goes on and on and on. What number do you think was the biggest hit of Archegos? Not only the fact they lost $35 billion, but what do you think the overall hit on Wall Street was of the Archegos meltdown?
Well, what was it?
10.5 billion.
Oh, that's tough.
10.5
It's larger than a lot of
billion
GDPs of
dollars.
the world.
That's a large amount of money. That's insane.
So long story short, basically, they took on this unprecedented risk using swaps.
Yep.
Couldn't meet the margin call because the market moved.
Yep.
And then they got stuck bag holding and basically collapsed as a fund as a result.
And to offset the risk and to bring up their margin call, they had to go initiate block trades. And that,
cover them.
Of course, cover them.
And it made
also
it worse.
Doing the swap. So it's the whole giant mess going on here. And now, everyone's sitting in their seats.
What now?
And they say, what now? So, you have Credit Suisse losing $4.7 billion. UBS just today or yesterday, announced that they lost almost $800 million. You have Morgan Stanley losing almost $1 billion on their prime deal. You have Nomura Holdings. You have Mitsubishi. You have all these large funds together losing $10.5 billion off one guy's. Now, I don't want to say that it was insider trading. It's nothing illegal. The guy just made a stupid call. All he had to do was margin. He was playing so thin on ice there.
Reckless,
essentially reckless. I got it. And when they look at it, the numbers we're looking at, that the fact that he wanted to get his fund to the $100 billion mark. So how can you get to a $100 billion mark when you're not meeting your calls, when you're not meeting your expectations? And it's very sad because everybody's sitting here and they're saying, they're scratching their head saying, what the hell? How did we let this happen? And we could discuss about this. Like, is this a matter of regulation? Do the regulators need to come in? I think not. I think we should let Archegos burn, and they messed up. So, you have a lot of people. And one thing I want to talk about, swaps are actually a really cool thing because you can actually, while mitigating your risk and your exposure, but not really owning the stock, someone else owns the stock on your behalf, you also are anonymous. So for a while, a lot of people were wondering, who is this guy who's initiating all these block trades by his primes? Archegos. Because the regulations is you can actually stay anonymous. You don't have to actually state who you are.
But
So,
yeah.
yeah.
So a little bit more on that. Yeah,
Mhm.
because you were talking about the regulation side of
Mhm.
things. And I did some research on that side of things. Because with this Archegos fiasco,
Mhm.
it's obviously an example of the derivative market going awry. You know what I mean?
Mhm.
It's a less regulated space. And we all seen before, like, during the 2008 crisis, like we've seen, this is history repeating itself. The insurance giant, AIG, nearly
Mhm.
collapsed under the weight of its own unregulated swap set at row.
Yep.
And we saw other massive banks take a hit, as you were saying, Credit
Lehman,
Suisse.
Bear.
Yeah, you're seeing that again, but more of a microcosm of that situation, and not taking
Mhm.
down the entire financial market with it. So this kind of unseen risk is what regulators, and more specifically Janet Yellen, have been being called on to regulate, because these sudden shifts in the market can then ripple across the whole market. And fortunately, it didn't take down the entire financial plumbing with it in this certain case. But when you're dealing with tens of billions, hundreds of billions of dollars,
Yeah.
you can really see this ripple effect, and it affect people's lives. So if we're getting the nitty gritty of what the SEC regulates, currently the SEC regulates that big institutional investors have to disclose their holdings of their stock each quarter.
Mhm.
But we see these disclosure rules really be limited to vanilla long positions and
Mhm.
typical positions that have been covered in past legislations, and that were mainly passed in the 30s and 40s, the Securities Act and such. But you don't see these large regulations cover the swaps that Archegos had. So banks who let money to Archegos actually never really had a full idea of the risk that Archegos was taking on. And that's kind of a key point, because these banks, they see the financial reportings, or especially analysts who only see financial reportings, they
Mhm.
see billions of dollars getting spent, but they're not really knowing where it's going. So it's kind of like these ghost trades. And when you're seeing billions of dollars be used this riskily, yeah, being used
Mhm.
with this amount of risk,
Mhm.
with this amount of money, it often leads to a recipe of disaster. So, like, to kind of get into it, the use of stock related derivatives has been going up sharply in the years, because usually when you have an opportunity to gain a lot of money and use a lot of has
Yeah.
with risk comes money. You know what I mean? To make a lot of money with not a lot of regulation, people will spring on that. So the amount of outstanding equity derivatives on stocks listed in the United States is just the U.S. So there's not even the full picture of Archegos, has doubled from 2015. So it was at $50
Yeah.
billion 2015, now sitting about somewhere 120, $130 billion. That's what the most recent data available. And I kind of pulled a quote from this guy I follow. His name is Tyler Gelach. He's a former SEC lawyer. He was a part of the 2008 crisis, and yeah, a former SEC lawyer. And he said, during the financial crisis of 2008, one of the biggest problems is that many banks didn't know who owed what to whom. So when you see these large movements in 8% and people losing $38 billion in the span of 5 days,
Yeah.
there's obviously something gone awry there, and
Yeah.
something that can take down the entire system like we saw in 2008. And thankfully, we didn't see a mass ripple effect across all the banks. I think Credit Suisse was the only institution that had to kind of restructure how it did things. But
I believe, I think a lot of these, I'm sorry to interrupt, but I think a lot of
yeah,
these, in
for
terms
sure.
of Credit Suisse, so the Credit Suisse thing, their two heads of prime brokers stepped down. They were like, this is too much for us. They left.
Probably a stern email like, you need
Very
to
stern.
submit your resignation tomorrow.
It was what's the
You have to show
thing they say?
investors that they're
No,
serious.
no, no, but there's like it was a respectfully resign. It was like a respectful, forceful resignation. They were like, hey, listen, you screwed up. Why don't you just put in the email and
Wipe your hands clean, and you'll give you a
our
nice
hands clean?
severance bonus.
Yeah, of
But
course, they always get nice
but
severance.
this goes back to what you're talking about,
Yeah,
on like our personal opinions on whether or not the derivatives market needs to be more
yeah,
regulated. Because you know what I mean. This happened because the only way this happened is because there's no reporting requirements on the trades that Archegos was doing,
yeah.
and whether or not that's right or not, or that it should be regulated, is being increasingly talked about, because something like this only happens as a result of a lack of regulation. And I'm not saying we should put
No,
regulate the entire
I'm.
derivatives market,
I mean, we
but
don't know. Like, there's no
yeah,
right
yeah, we don't
answer.
know. There's no way of knowing that if regulation existed, that this wouldn't have happened. But
Yeah,
there's been an increase in these ghost trades, so to speak,
of
where they
course.
can avoid reporting requirements and kind of avoid having to report the
Yeah.
risks that they're undertaking.
Yeah.
Because as you know what it is, at the end of the day, hedge funds are always going to chase the profits. Like you said, you
Of
wanted to reach
course.
$100 billion, and he was well on track to. But your investment thesis is only as good as it's performing, and when it's not performing, you can take down an entire financial system.
I mean, exactly. And Huang had 10 billion of his own money, but he was leveraging all that money
Mm,
with all that stuff. So, you know, because he was leveraging with these not margin calls, because he was leveraging with all these swaps, the total return swaps, he had 30 billion. The fund managed 30 billion, but of course, 10 billion of that was his own money. So a third of the fund was his own money that he just sort of playing around with as if it was nothing. And on the block trade, just off a small, simple block trade, 30 billion of value just evaporated. So 30,
gone.
the whole massive sell-off, 30 billion was just gone off the markets. So you have someone who's playing so much leverage, who's over leveraging, who's playing swaps, who's talking to their prime brokers. And it's not just one prime. This guy dealt with like 5 or 6 primes, as we saw. So can you imagine if he only put one pressure on like Credit Suisse itself, or he put all that leverage, or he put all that accountability on Goldman itself? Can you like that'd be crazy? And I'm with you. There is no right or wrong answer for regulation, because if you have regulation, you can constrict a market where it's not operating on its full to its full potential, and if you unregulate the market, everything can go haywire. It's the Wild West out there. People are carrying
Yeah.
6 shooters and just doing all the stuff. So, and I don't know what's right regulation. I'm only, 21. I'm not an expert on this. And I don't think, even financial professionals come out here. They can't even say what's right or wrong
Yeah,
regulation.
there's large. It becomes a very political thing as well.
Yeah,
You
exactly.
know what I mean?
Because you have one side calling for regulation, you have one side calling for deregulation,
The free
and then
market type of
free
enterprise
market.
type of mentality.
Exactly, and no one can meet in the middle because they say, well, you're wrong because you're constricting markets from doing what they're meant to do, and they're free, and let them breathe. And then you have one side saying, well, hold on a minute, if they're free, how come you have all this manipulation? How come you have all this,
Mhm.
loopholes that are going on? They're like, oh, well, that's just the market. And then of course they bash heads and they never really get the real issue done.
Well,
So
yeah, that's the thing about regulation, though, because
yeah.
at least in general, not even just for financial markets and
Hmm.
regulating financial instruments and products,
Hmm.
laws in general are very reactive. Usually,
Yeah.
something, especially for the financial plumbing and the financial regulation in this industry, something has to go wrong first in order for something to change, and that's
Exactly.
what we've seen over the last decades, from the GFC to even now.
And that's
So,
what
I mean, I think the issue here is whether regulation is needed or not, is if this happening is acceptable. You know what I
hmm
mean? Because obviously it's not taking down an entire financial system
no.
like we saw 10 wow 11 years 12 years ago 13 years ago, a long time ago. But
Yeah.
does it this $30 billion evaporating over 5 days, and
I
whether or not that
yeah.
should happen um
Mhm.
is kind of the conversation I think needs to be had. Neither whether or not we need to make a regulation so this never happens again.
Yeah.
Should this be able to happen? I think that's the prime question we need to ask here.
And you also think about it that, is it stupidity? Is it market manipulation? Is it just someone who made the wrong call and didn't want
Greed,
to
stupidity. Yeah, it's
exactly
a
greed,
bunch of
stupidity?
things. You know what I
What
mean?
is it? And I don't want to say like I don't want to say Huang's stupid or not stupid.
No,
Maybe
no, not at
he
all.
had
That's
a
not what I'm
good
trying to say.
plan. It's just the plan fell through. It's just and you look at '08, right? You look at 2008. I mean, people mistook. There was that famous quote from The Big Short. They took stupidity from leverage. So they took stupidity for
I
leverage.
forget.
Yeah, it's something like that. So it's just it's a giant mess when it comes to regulation. I don't know. I hope everyone can come to the middle and say, listen, let's learn from this. Let's make sure that maybe we tweak the laws a little bit for swaps. We tweak the laws a little bit for derivatives and
Just make it
primes.
more transparent, because
Make it
this
more
was
transparent.
no one knew what
They were a
Archegos
whale.
wasn't like a household name within at least
No.
people who know about this stuff, know are financially literate of what's going on
Yeah.
In markets,
Hmm.
until this went wrong and you're like, oh, someone lost $30 billion within 5 days. You know what I mean? So, and I
Yeah.
think just to kind of not switch gears too much, but one thing I thought you brought up that was kind of interesting was the reporting requirements required because
Oh yeah.
Archegos was exposed to Chinese companies, who are known to have not necessarily the most
Mhm.
stringent reporting requirements. I mean, if
No.
we're looking back a year, like I don't know if you heard of Luckin Coffee, it was like the
Yeah.
Starbucks of Asia, and that whole fiasco that happened where they basically all the
The books were
yeah,
cooked.
the
The books were
CFO,
totally
the
cooked.
CFO basically, yeah, made up a bunch of sales that
Yeah.
didn't happen.
And
So, you know what I mean? You have the issue of the different financial systems of different companies and
exactly.
how that can bring down other financial systems. And
Yeah.
that'd be actually a good topic for another day.
We should
But
definitely look
yeah.
into that. And on kind of a closing statement, two things.
Mhm.
The repercussions of 2008 led to Dodd-Frank. Dodd-Frank was passed in 2010, and of course, it was since been repealed
Yeah, good. Yeah.
under the previous administration. So, when we're talking about regulate, it's a slippery slope because you start spiraling out because you can say, well, look at these previous years. I mean, I don't know if you ever heard of long-term capital management, that hedge fund that defaulted.
Oh yeah, yeah, I heard about that. Yeah.
What was the one type of derivative they used? Swaps. And what happened? Literally the fund like evaporated. They had such amazing progress, and then all of a sudden, bam, the whole thing collapsed right in front of everyone. And these were Nobel laureates. These were like top computer scientists, economists, statisticians and mathematicians who like went ahead and built a hedge fund just purely based on math and science alone. And they were doing really well. And then they just sort of disappeared off the face of the earth. So it's very interesting. Thank you,
Yeah.
Paris,
My
for
last thought is that
yeah, go for it.
for derivatives, I think a lot of the times now people are chasing
Hmm.
yield and you end up going down a derivative rabbit hole where you keep
Hmm.
repackaging something until you don't even know what the something is anymore. You know what I
No,
mean?
not
And
at all.
eventually once you go down this derivative rabbit hole and you don't even know what this thing you're trying to sell is anymore, I think you're bound to go into you're bound to see something go wrong.
Exactly.
And that's my thought on it. And whether or not that needs to be addressed
Yeah.
is a bit bigger than what my intelligence can bear
Yeah.
right now. But yeah,
I'm with
that's
you
just
on that
my
one.
thought. But
I mean,
you want to end it there or one more thought?
well, I'll just say one thing. So you,
Hmm.
you said about like derivatives that are being traded so much people don't know.
Hmm.
2008, there was something called a synthetic CDO, which mimicked a CDO, a
Collateralized debt
collateralized debt
obligation.
obligation, but it had nothing in it. It had no value. At least a collateralized debt obligation is like, okay, there's a home, there's mortgages, there's all these stuff behind it.
Yeah.
A synthetic CDO literally mimicked a CDO with, it's like
Just
taking a
follow
glass.
CDO following another CDO.
It's like you take a glass of water and you say, this glass of water has value because there's water in it. Perfect. You take an empty glass of water and you say, this is the same thing as the one with water in it. You're like, wait a minute, that doesn't work. Like, no, but they act the same. That's what's crazy about it. And they mimic the same the empty glass of water mimic the same as the full glass of water, and they were proposed the same thing. But yeah, I think we're gonna end it there. Otherwise, we're just gonna go in the rabbit holes of
Yeah, we're going to
derivatives.
rabbit hole the GFC. And once you start talking about the great financial crisis, then it's
It's a
just,
mess. We should
yeah,
do
then there's a lot of subjects there to cover
we
and
should
what
do
was
that one of
wrong
these days. Do like a
and
2 hour
how,
podcast on the implications of the financial crisis.
yeah, into today.
Yeah, but
Yeah.
anyway, thank you very much, Paris,
Also,
for
thank you
doing
to
that.
Jake
Yeah,
for
thank you, Jake, for
producing
producing
us.
this. This is awesome, buddy. Thanks so much, man. Can't wait to see it. And we hope you enjoy. Again, questions, comments, concerns, please post in the comments. You can find us
Video
at
ideas.
video ideas. Go ahead and reach out to us. Thank you very much for the TSS, of course, the Street Smarts, and Michael for helping us uh, do this and hosting it on their platform. So please go ahead and check them out. And of course, Paris and I are not financial professionals. Please do not take everything we say as financial advice. This
There it
is
is.
only our opinion and our opinion only, and we hope you can use this for
I was
education.
waiting. I was waiting for that. I was waiting
And
for that. I
yeah,
thought
I
my,
have
my, my
to. I
guess
have
was the
to.
first 5 minutes, but the
But no, this is like the
last
last
minute is
minute.
fine as long as we get it in there.
Of course. Thank you guys so much. Enjoy
All
the
right.
podcast. Have a good one, Paris.
All
Thanks,
right.
Jake.
You too, Solar. Let's call
Bye,
it there.
guys.